In 2020, a Dalbar study tracked 20 years of retail investor behavior and found something uncomfortable. The average investor earned 4.3% a year. The market returned 8.2% over that same period. Nearly half the gains are gone, not because of bad luck, because of a flawed framework that told people exactly what to do and left out everything that could go wrong. A lot of those investors were following the 8-4-3 rule. It promised a clear path: 8 years of slow accumulation, 4 years of building momentum, 3 years of explosive growth. Elegant, logical, and built on assumptions that no longer hold. So here's the question worth sitting with. If the rule was designed for a world of smooth, predictable, 8% annual returns, what happens when that world stops showing up? That gap between the promise and the reality is what this video is about. Because if your framework was built for conditions that no longer exist, it does not just underperform. It quietly works against you year after year, while the math looks fine on paper. My name is Alex, and if you have ever looked at your portfolio and felt like the growth should be further along by now, stay with this, because the problem is rarely discipline or patience. And I'm going to show you exactly where the 8-4-3 rule breaks down and what a more resilient framework looks like in its place. Once you understand how the structure fails, you will stop waiting for compounding to save you and start building a system that actually accounts for how markets behave. The failure is not random. It traces back to 3 specific assumptions baked into the rule from the start, and the first one is the most damaging. Most rules that get passed around in personal finance were not designed to be questioned. They were designed to be remembered, simple enough to repeat, clean enough to share, and just credible sounding enough that nobody stops to ask what they are actually built on. The 8-4-3 rule is one of those. On the surface, it makes sense. You invest consistently for over 15 years, and the journey breaks into 3 phases. The first 8 years are the slow grind. You are putting money in, the balance grows, but it does not feel like much is happening. In the next 4 years, momentum starts to build. Returns stack on top of returns, and the curve begins to bend. Then, in those final 3 years, compounding hits its stride. The growth feels almost automatic. The math works. The system delivers. That is the pitch. And for a while, for a specific kind of market, it was not wrong. Here is where it starts to unravel. The entire model rests on one assumption: that your investments will return roughly 8% every single year, like clockwork, year after year, without interruption. Smooth, predictable, linear. Take that assumption away, and the 3 phases stop making sense. The timelines slip, the curve does not bend when you expect it to, and you're left holding a framework that no longer matches the market you are actually invested in. Think about what that 8% assumption is really saying. It is saying that the market cooperates, that there are no major crashes in year 3 or year 6, that inflation does not quietly eat into your real returns, that interest rates stay low enough that your opportunity cost stays manageable. It is saying a lot of things, and it is not saying any of them out loud. Now consider what has actually happened. Since 2000, US markets have lived through 4 major crashes: the dot-com collapse, the 2008 financial crisis, the March 2020 shutdown shock, and the 2022 rate-driven correction that took the S&P 500 down nearly 20% in a single year. Each one of those events, if it landed at the wrong point in your 8-4-3 timeline, scrambled the whole sequence. Year 6 of your foundation phase does not feel the same after a 30% drawdown. The rule just tells you to keep waiting. It has no answer for what you're actually experiencing. And this is where it gets personal. Take someone like Marcus, a 37-year-old project manager in Denver. He started investing seriously at 29, putting $12,000 a year into a broad index fund. Consistent, never missed a contribution. By his calculations, he should have been deep into the momentum phase by 2022. Instead, he watched his balance drop by just over $61,000 in 11 months. The 8-4-3 rule told him he was in the compounding phase. The market told him something else entirely. He did not panic sell, but he came close. And the reason he came close was not weakness. It was that his framework gave him no way to understand what was happening. It only told him what was supposed to happen. That is the real cost of an outdated rule, not just underperformance. It is the absence of any explanation when things go sideways, which in real markets, they always eventually do. Here is what the Dalbar data actually shows when you look at the most recent 2025 report covering a 20-year window. The average equity fund investor earned 5.1% annually. The S&P 500 returned 9.8% over the same period. That gap is not explained by laziness or bad stock picks. It is explained by behavior, by investors using frameworks that were not built for volatility, making emotional decisions at exactly the wrong moments, and losing years of compounding in the process. The principle of compounding is not the problem. Compounding still works. It is one of the few things in finance that genuinely does what it promises. The problem is the rigid, phase-based system built around it, one that assumes the road will be smooth when the road has never, not once, actually been smooth. And that assumption does not just affect your timeline. It creates three specific cracks in the foundation, cracks that quietly widen every time the market does what markets do. When a system fails, it rarely fails in one place. It fails in several places at once, and those failures reinforce each other until the whole thing collapses quietly while you are still trusting it. The 8-4-3 rule has three of those failure points. Each one would be a problem on its own. Together, they explain why so many disciplined, consistent investors end up with results that do not match the effort they put in. The first crack is the one nobody talks about until it is too late. The rule treats time as protection. Stay in long enough, and the market will smooth out. That sounds reasonable, but it is only reasonable if the timing of bad events does not matter. And it does. It matters enormously. Since 2000, U.S. markets have crashed significantly 4 times. The average peak-to-trough decline across those 4 events was just over 41%. Now think about what that means if one of those crashes lands in year 5 or year 6 of your investing journey, right in the middle of what the 8-4-3 rule calls your foundation phase. Your balance is not large enough yet to absorb the hit. Your contributions are not large enough to meaningfully buy the dip. And the rule's only instruction is to wait. No repositioning. No response. Just patience. Patience is a virtue in investing. But patience without a plan is just hope. And hope is not a strategy anyone would consciously choose if they saw it written that way on paper. Here's what actually happens to real people in that moment. A financial analyst named Diana, 41, had been investing since her early 30s. 10 years in, she had built a balance of around $214,000. Then 2022 arrived. By October of that year, her portfolio had dropped to roughly $153,000. $61,000 gone in less than 12 months. Her framework told her she should be approaching the high growth phase. Instead, she was back to numbers she had last seen 4 years earlier. She stayed the course, but she also spent the next 18 months second-guessing every assumption she had built her plan around. That psychological cost is real, and it compounds too, just in the wrong direction. The second flaw is quieter, but just as damaging. The 8-4-3 rule says almost nothing about what you actually hold. It is a timeline, not a portfolio. And it assumes that whatever you are invested in will behave the way the broad market historically has. But a concentrated portfolio, heavy in one sector, one asset class, one geography, does not behave like a diversified one. It behaves like a bet, and a bet that goes wrong in year 7 does not give you a tidy 3-year recovery window. Diversification is not a concept that the 8-4-3 rule integrates. It treats it like an afterthought, something you figure out separately. That is a serious omission, because the difference between a portfolio with genuine structural resilience and one without it is not just performance in good years, it is survival in bad ones. The third flaw is perhaps the most expensive, and it is the easiest to overlook. The rule assumes flat contributions, same amount every month, every year, for 15 years. But here is what flat contributions actually cost you. If you invest $400 a month for 30 years at a 7% average annual return, you end up with just over $482,000. Now run the same scenario with contributions that grow by just 3% each year, roughly in line with modest income growth. Your ending balance climbs to over $730,000. That is more than $250,000 of additional wealth, generated not by taking more risk, but simply by not letting your contributions stay frozen in time. Flat contributions are not neutral. They are a quiet drag on everything the compounding engine is trying to do. So you have a rule that cannot respond to crashes, does not account for what you hold, and assumes your contributions never grow. That is not a minor gap to patch. That is a structural problem, and it calls for a structural solution, which is exactly what the 7531 framework was built to be. There is a particular kind of frustration that comes from doing everything right and still feeling like you are behind. You are contributing consistently. You are not panic selling. You are playing the long game, and yet the results feel disconnected from the effort. That frustration is not a character flaw. It is usually a sign that the framework underneath the effort has a design problem. The 7531 framework is a direct response to that problem. Each number addresses one of the three structural failures the 843 rule left unresolved, and then adds a fourth layer that the old rule never considered at all. Start with 7. 7 years is the minimum time commitment the framework asks for, and it is not an arbitrary number. When you look at every rolling 7-year period in S&P 500 history going back to 1950, the average annual return across all of them was positive, every single one. There were brutal stretches inside those windows, crashes, recessions, rate shocks, but over any 7-year span the data covers, the investor who stayed in came out ahead. That is not a guarantee about the future. It is a statement about how much runway compounding actually needs before it starts doing the heavy lifting reliably. The old rule asked for 15 years. The new framework asks for 7 as a floor, not a finish line. The distinction matters because it changes how you think about volatility. A crash in year 3 of a 7-year commitment is not a catastrophe. It is an opportunity to buy more of the same assets at lower prices, inside a window long enough for recovery to happen before you need the money. Now the 5. This is the diversification layer. 5 categories that together build a portfolio with genuine structural resilience. The first is a broad market index fund, your core exposure to overall economic growth. The second is dividend-focused funds, which do something most people underestimate. Reinvested dividends have accounted for roughly 84% of the S&P 500's total return since 1960. Not 84% of some portion of the return, 84% of all of it. That income stream is not decorative. It is foundational. The third category is small and mid-cap growth funds, which historically outperform large caps over long periods, even if they are bumpier along the way. The fourth is international funds, not because the US market is unreliable, but because geographic concentration is a risk, and one that does not announce itself until it is already expensive. The fifth is defensive assets, bonds, treasury inflation-protected securities, or similar instruments that hold value when equities fall and give you something stable to rebalance from during downturns. None of these 5 categories is exotic. The sophistication is not in the individual pieces. It is in holding all 5 deliberately, together, so that the portfolio as a whole can survive what any single part of it cannot. Then the 1%. That is the minimum annual increase to your contributions. And this is where the math becomes almost uncomfortable to look at. Consider 2 investors. Both start at $350 a month. Both invest for 30 years at a 7% average annual return. The first keeps contributions flat. At the end of 30 years, they have approximately $494,000. The second increases contributions by just 3% each year, less than most people's annual raise. Their ending balance is just over $812,000. Same starting point, same time horizon, same market. $318,000 of difference, produced entirely by not leaving contributions frozen. That is the mechanism, not a better stock pick. No more risk, just a contribution that grows modestly over time, the way income tends to for most working professionals. The 7 handles time, the 5 handles structure, the 1 handles acceleration. Together, they address everything the old rule left exposed. But here's the thing about a framework this rational and this well constructed. It still has to survive contact with something the numbers cannot fully prepare you for, and that is your own psychology. Because the 3 most predictable emotional phases of any long-term investment journey will each arrive on schedule, whether you're ready for them or not. Nobody warns you about the emotional calendar of long-term investing. The volatility charts, the return projections, the contribution calculators, they all exist. But there is no chart that tells you exactly when you're going to feel like quitting, or why that feeling will arrive right on schedule, or how close to the turning point you usually are when it does. That gap is not an accident. It is just something most frameworks do not account for. The 7531 framework does. And that is what the 3 represents. Not a time period, not a portfolio category. 3 predictable psychological phases that will test any investor who stays in long enough, regardless of how disciplined or informed they are. The first phase is doubt. It arrives early, usually somewhere in the first 2 years. You are contributing consistently, and you are doing what the framework asks. But your balance is small, the growth feels invisible, and a quiet voice starts asking whether any of this is actually working. This is not a rational response to the data. At 2 years in, compounding has barely started. The math is fine, but the math does not feel like much when the number on your screen is still modest, and the sacrifice to get there was real. Doubt is the easiest phase to survive, because at least it arrives before you have too much at stake. Most people push through it. The second phase is harder. Frustration tends to settle in around years 3 and 4, and it is more dangerous than doubt because it feels more justified. By now, you have put in meaningful money. You have stayed through the early discomfort, and the growth still feels linear. Steady, yes, but not exciting. Not transformative, not what you were told to expect. The curve has not visibly bent yet. The compounding engine is running, but from the outside it does not look like it. This is the phase where most people make their worst decisions. Not because they are irrational, but because they are tired, and the payoff still feels abstract. Dalbar's most recent data shows that the average investor holds an equity fund for less than 4 years before making a significant change. 4 years. Which means the majority of retail investors are cycling out of their positions right around the point where the real acceleration was about to begin. Think about what that means in practice. A healthcare administrator named Priya started investing at 32. $500 a month, diversified across the 5 categories, contributions increasing by 2% each year. By year 4, she had contributed around $25,000, and her balance sat at just under $28,000. Progress, but not transformation. She told a colleague she was thinking about moving everything into a high-yield savings account instead. What she did not know was that by year 8, if she stayed the course, her projected balance at the same contribution rate would cross $91,000. The curve was about to bend. She was standing at the base of the steepest part of the slope, looking at flat ground and concluding the slope did not exist. She stayed, but the decision was closer than it should have been. The third phase is panic, and unlike doubt or frustration, it does not arrive on a schedule. It arrives when the market does what markets always eventually do. It crashes. Your balance drops in a way that feels permanent, even though it never has been. Every instinct you have tells you that action is better than inaction, that getting out now limits the damage. That instinct is wrong, and it is also completely understandable. The investors who survive all 3 phases are not the ones who feel nothing. They are the ones who had a plan for the feeling before it arrived, who decided in advance what they would do when doubt crept in, when frustration peaked, when the portfolio fell 20% in a quarter. Write that plan down before you need it. Decide now what staying in looks like when everything in you wants to leave. Automate your contributions so the decision is already made. Check your balance quarterly, not weekly, because the more frequently you look, the more frequently you will find a reason to react. Track your contribution streak, not your returns. The habit is an asset in the early years. That is the psychological architecture that the 3 are asking you to build. And once it is in place, the only thing left is to translate all of this, the framework, the mindset, the awareness of what is coming, into a concrete 5-step action plan you can start on today. Understanding a framework and actually implementing one are 2 completely different things. You can walk away from this video with a clear picture of why the 843 rule fails, why the 7531 framework addresses those failures, and exactly what the psychological phases look like before they arrive, and still do nothing, not because you are lazy or unconvinced, but because understanding without a specific next action tends to dissolve within about 48 hours. The insight fades, the urgency softens, and the old defaults quietly reassert themselves. So before that happens, here is the concrete sequence. 5 steps, in order, starting today. Step 1 is the commitment. 7 years, minimum. Not as a vague intention, as a decision you make concrete. Write it down. Put a date on it. If you are starting today in April 2026, your minimum horizon ends in April 2033. Tell someone whose opinion you respect. The research on commitment devices is consistent. People who externalize a goal are significantly more likely to follow through than people who hold it privately. This is not motivational advice. It is just how accountability works mechanically. Step 2 is the restructure. Look at what you currently hold and map it honestly against the 5 categories: core broad market exposure, dividend generating funds, small and mid cap growth, international diversification, defensive assets. You do not need equal weight across all 5, but you need intentional weight. If your portfolio is 90% concentrated in large cap US equities right now, you are not diversified in any meaningful sense of the word. You are exposed. Restructuring does not mean liquidating everything and starting over. It means using new contributions and gradual rebalancing to move toward a structure that can survive what your current setup cannot. Step 3 is automation. Set up automatic contributions at whatever level you are starting from. Then set a separate automation, a calendar reminder, an automatic increase through your brokerage, whatever the mechanism, to raise that contribution by at least 1% each year. The reason automation matters is not convenience. It is that it removes the decision from the emotional environment. When the market drops 18% in a quarter, an automated contribution goes in anyway. A manual contribution requires you to decide, in that moment, to buy into something that feels like it is falling apart. Most people cannot consistently make that decision correctly. Automation makes it irrelevant. Step 4 is the written emotional plan. This sounds like the softest item on the list. It is actually the one most likely to protect your returns during a downturn. Take 15 minutes before your next market crash, which will happen on a timeline you cannot predict, and write down your answers to 3 questions. What will I do when my balance drops 20%? What will I do when I've invested for 4 years and the growth still feels slow? What does staying the course actually look like for me in practice when every instinct says otherwise? A financial planner named Jerome worked with a client in 2022 who had written exactly this kind of plan 2 years earlier. When the S&P 500 fell 19% that year and her balance dropped by over $67,000, she pulled out the document, read it, and did not sell. That document, written in a calm moment, was more valuable than any analysis she could have done in the middle of the panic. Step 5 is the scheduled annual review. Go into your calendar right now and block 1 hour once a year to do 3 things. Confirm your contributions are increasing. Rebalance your 5 categories back toward your target weights. And review your emotional plan to make sure it still reflects how you actually want to behave. That is the entire maintenance burden of this framework. 1 hour a year. Everything else runs on its own. Put these 5 steps side by side with the 8-4-3 approach, and the difference becomes structural. The old rule gave you a timeline and told you to wait. This framework gives you a system and tells you exactly what to do at every stage, including the stages that feel the worst. The framework is now complete. The structure is in place. And that brings us to the question this whole video has really been building toward. Here's what this video was really about. It was not about finding a better rule to follow. It was about understanding why the rule you were using is built for a world that no longer exists, and what that has been quietly costing you. The compounding engine still works. It has always worked. What breaks the outcome is a framework that assumes smooth returns, ignores what you actually hold, freezes your contributions in place, and leaves you with no language for what you're feeling when the market turns against you. When you notice the urge to check your balance after a bad week, that is the framework being tested. When a contribution increase feels uncomfortable, that is the mechanism working exactly as it should. When the growth feels slow in year 4, you are probably closer to the bend in the curve than you think. The question worth carrying forward is this. Most investors focus almost entirely on what they invest in. Very few spend equal time on when they will be tempted to undo it and what they will do in that moment. That second question is where most of the real money is won or lost. If this reframes how you think about your own setup, share it with someone who is still running an outdated playbook. And if you want to keep pulling on this thread, subscribe, because the next video examines why even well-diversified investors consistently mistime their rebalancing and what the data says actually works instead.